I'm Peter Harris. I'm a venture capitalist that's been investing in companies over the last 14 years. I do everything from Series A, early stage when a company's doing a couple million in revenue, all the way to late stage companies that are doing literally in billions of dollars in revenue and everything in between. And so today we're going to talk about how public markets, which are in total free fall right now, especially as it relates to technology companies and companies on the NASDAQ, are impacting venture capital, which is primarily investing in technology-based businesses. So the first thing that should be obvious is that as public market valuations come down, right, that is going to have an impact on valuations in the private market. And the reason for that is because as an investor, right, if I invest in a company at $100 million valuation with the belief that it someday could be worth $1 billion, then I'm going to be more excited about investing in that company. But if all of a sudden the company that I thought would be worth $1 billion when it went public is now only worth 500 million, now I'm less excited about the deal. And in fact, given the risk, I may actually go back to the entrepreneur and say, hey, $100 million valuation's too high. We need to reduce it to maybe like $50 million. And in some cases, some of these tech stocks have dropped by 80%. That means that if they were valued at $10 billion 9 to 12 months ago, and now today they're only valued at $2 billion, like that's a huge haircut and has a huge impact on valuations. Now, here's the one thing that makes it a little more tricky is that private markets aren't as liquid as public markets. And so the valuations, they don't change quite as drastically. And the other thing that's happening is entrepreneurs, for the most part, are still in this mindset of like, hey, 12 months ago, even 24 months ago, even 36 months ago, I was getting really high valuations. And all of a sudden, you're telling me my company's not worth as much as I thought it was, or what it was worth even 3 or 6 months ago. And that can be a bit of a awakening call for a lot of entrepreneurs who then push back and say, well, fine, we're just not going to invest. So you have a bunch of these different dynamics at play. Over time, though, public markets do influence private markets. And so you'll see this alignment. Like today, even now, like I'm seeing deals on the private side that, in my opinion, are just massively overpriced. And those deals are it's really hard for those deals to get done. But over time, what'll happen is those things will correct and normalize. I also think public markets are probably beating up on tech stocks a little bit too much. And so we will see some rise in tech stocks, but I don't think we'll ever go back to the day where some of these tech stocks were being valued at 100x revenue. I just don't think, it's realistic because it just means that you have to wait even longer for those companies to start generating a real return when they generate profits. So that really ties me into another aspect of all this, which is exits. So as a venture capitalist, right, I'm looking, especially on the growth equity side, I'm looking at investing in companies and thinking, when can I realistically get this company to exit? In some cases, the company will be like a year or two out from going public. In fact, there were a lot of companies that we know that were saying, hey, we're going to go public in 2022. It's our year. And now they're looking at it and they're saying, whew, this is not the market I want to go out in, right? Because pretty much every company that's gone public in the last 12 months is down significantly. And so they're now saying, hey, I want to push off when I go public. And then you add on top of that the drops in valuations. That is having an impact on valuation as well. But it also means there's a lot of companies coming back to VCs and saying, hey, that capital that I thought I was going to be able to raise in the public markets is no longer available to me because I'm not going public as quickly. I need another round of funding. And the more desperate you are as a company for funding, the less power you have around your valuation. And that also ends up driving down valuations. So what this means, though, is, as you can probably guess, there's a bunch of companies coming to venture capitalists and pitching them for money right now. They're doing it because either they need to extend their runway because they've burned through all of the cash that they raised. It could be because they thought they were going to go public and raise more money, and now they've had to kick the can down the road. And it could be because they see the writing on the wall and they want to make sure they have a nice, healthy buffer to get through it in case things get even worse than they are today. What that means, though, as a venture capitalist, is that the tables have shifted. So for the last, call it 3 to 7 years, really, the tables have been strongly in the entrepreneur's favor, and every year it's just gotten stronger and stronger for entrepreneurs until this year. Now the dynamics are starting to shift back to venture capitalists because these companies have been burning tons of cash to grow at all costs. And by doing so, they've kind of given up their freedom from venture capital money. and now they got to come back. So that's been putting VCs in a much stronger position. What does that mean? Well, 6 to 18 months ago, deals were getting done lightning fast, right? There were stories of like venture funds calling up an entrepreneur and within an hour-long conversation, sending them a term sheet and then closing 2 weeks later on massive rounds at huge valuations, right? That is strongly in the entrepreneur's favor, right? Because entrepreneurs don't want to be out there fundraising forever. And so they're able to close capital really fast at high valuations. Like, they love that. That made it really challenging for VCs. Like, I know a lot of VCs that were like, I have not like slept in like weeks because I'm just working on deals because we got to get them closed, right? Now it's shifting back. What that means is that venture capitalists are going to take a lot longer to evaluate deals and make decisions because they've got a lot of options on their plate. Companies are desperate and they're really in a power of control. It also means that like venture capitalists are going to be looking for a slightly different type of business. They don't want to invest in companies necessarily that are focused on growing at all costs. They want to invest in companies that they know are going to be around 3 years from now and will survive the recession, which means businesses that are very capital efficient, hopefully near break even or profitable, or have such strong, fantastic metrics that they can raise money from anybody at any point, right? And the way they get really strong, fantastic markets is they are solving a pain point that nobody else is solving to the extent they are, and they're doing it incredibly well. So if you're an entrepreneur, like look at your business. You either need to cut and get yourself to a more profitable state, or, the businesses that already are more capital efficient, if you're operating one of those, like you should feel pretty good about your position because one, you may not need venture capital, and two, you're the type of company that VCs are going to be searching out for. Okay, and then the last thing I want to talk about is available capital. So another thing that kind of puts VCs in a little bit more of the driver's seat and also creates kind of the scarcity of capital is that VCs have put in a ton of money into these companies that have been burning a lot of cash over the last 18 to 24 months. And they're incentivized to keep supporting those companies because if they don't give those companies money, they lose their entire investment. And even though sunk costs are sunk, sometimes this is like really hard as a VC, right? Like you've already put in tens of millions of dollars into this business. You don't want to lose those tens of millions of dollars. So you might put in some more. What that means, though, is that venture funds are basically reallocating money that they would have put into a brand new company, and they're putting it into their current portfolio to help it survive. One of the dynamics that's happening that like exacerbates this is you've got younger partners at venture funds that have made some deals that have done incredibly well over the last couple of years. And now those companies are in a tough spot, right? They were growing super fast, growing at all costs, super high valuations. And those deals kind of made the career of the VC, right? It's like, hey, I was like first money into this company that's now worth $10 billion, right? And that investment we made is worth $1 billion to our firm. You don't want to have that company go out of business, right? As a partner. And so you might be strongly tempted to throw good money after a company that's not very good in this environment just to keep it afloat so that you don't lose all your money on that deal. All right, the one last thing I want to share though about the current market is even though like it really sucks, last year was phenomenal for venture capitalists. And here's one of the dirty little secrets about venture capital is that as much as we all like to point fingers and say like bubbles are terrible and bad and blah, 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 like venture capital lives and dies on bubbles. Like we as a venture industry have been like praying for the glory days of the .com, right? I was talking to a VC a few years ago and he was like, man, it must have been so awesome when you were a VC in the .com era because like you could put money into just about anything and it would drive huge returns. And that was because like the .com frankly was a huge bubble. And the last few years have been a big bubble and VCs have made a killing selling their positions in companies that they have backed over the last 5 to 10 years. Think about how much money was generated in returns on companies like Airbnb that went public, on Coinbase, on Uber, on a lot of these businesses, right? So it's been a fantastic year for VCs. So don't feel too bad for them. And frankly, it's been a great year for entrepreneurs. Think about all the entrepreneurs who have taken their companies public and realized huge windfalls from the success of those companies. So look, we're going through a tough time. There's going to be down rounds, there's going to be flat rounds, there's going to be companies that go under. There's going to be a lot of carnage. But the flip side is, as a VC, like, now's a great time to invest. Like I said, the tables are shifting back to venture capitalists and valuations are coming down. And historically, some of the very best deals have been funded during recessions. Companies like Airbnb were started during the last recession. So there are huge opportunities for those that have cash to deploy and are willing to make bets in this current environment. Anyways, tell me what you think down in the comments. Do you agree with kind of my assessment on valuations and how the current markets are impacting VC, or do you have a differing opinion? Or are there other ways in which it's being impacted? Also, join me for our next video where we're going to talk about how inflation specifically is impacting venture capital.